Hello and welcome viewers tuning into this insightful and timely session, providing insight to the lithium market during LME week here in London. Thank you to all my guests for tuning in from around the world and my panelists, of course. We'll be covering some of the challenges and realizing how our lithium-ion battery-driven futures are going to be playing out indeed. So we'll have some market context text to begin with, start off with a few slides, and then we'll delve into the real meat of the actual discussion as well. So introducing my stellar panel, I've got some business leaders, sector leaders, investors, everyone from across the value chain. Really, it's a great panel. I'm very pleased to have assembled here. I have Daniel Jimenez, partner at EnergySource Markets, Kelly O'Brien, head of investor relations at SQM, David Deek, PhD, chief development officer at EnergySource Minerals and president of Marbex, and Alex Grant, principal at Jade, Cove Partners. So thanks very much, everyone, for giving your time to share us some insights today. And let's begin by framing the lithium market. So Daniel, could you please start us off with your introduction? Thank you.
Yes, okay. Thank you, Adam, and hello, everybody. Thank you for having us here and listening to us. I will give you a very brief overview about how we are seeing the lithium market today. If this works, we're going to. Okay, so the first thing to look at, apologies, this is not got. Here we are. The first thing when we think about lithium, we have to think about electric vehicles. That is what is driving the whole demand. Lithium, at the end of the day, is an EV story. And what we are seeing here is that during this year, the world will probably reach global EV sales of 10 million vehicles. That compares with 6.4 million last year and 3 million in 2 years ago. So this is an enormous growth of anywhere between 3 and 4 million vehicles per year. And as a rule of thumb, for every million vehicles you need, for 1 million vehicles, you need anywhere between 40 and 50,000 tons of lithium carbonate equivalent. So the demand growth this year alone, the EV sales growth this year alone, mean that demand for lithium will grow between 150 and 200,000 tons, which is an enormous number if you consider that the global demand in 2017, so that was yesterday, was 200,000 tons. And when we look into the future, the demand for lithium is going to grow at similar rates, or similar absolute numbers over the next years. The demand for EVs is driven by EV sales, obviously, but the element we'll look at is penetration rates in passenger vehicles. And passenger vehicles are the bulk of the lithium demand of batteries. And we will see this year a global penetration rate of EVs of around anywhere between 10 and 11%. And the forecasts, and these are more or less in the consensus, is that by 2025, that is going to be anywhere between 24 to 25%, and by 2030, between 43 and 45%. So basically in 8-9 years from now, half of the passenger vehicles sold globally will be electric vehicles as we define them here, and this means pure electric vehicles or plug-in hybrids, which each of them, I mean, they draw their energy from being plugged into the grid. In terms of demand over the next 5 years, what does it look like? We're going to see demand growing this year. We'll probably reach close to 700,000 tons of global demand. And in our models, we have for 2026 around 1.7 million tons of global demand. And if you look at the graph here at the top of it, the bluish part of the columns is essentially energy storage, and the dark blue is electric vehicles. So that's why we were so much focused on looking what happens with electric vehicles. What is happening in this industry as well? We're starting to see that OEMs are integrating upstream, but at the same time, we see that many of them are integrated to a level of cell manufacturing, so of batteries, but they have not been too aggressive in moving further upstream. And that is something which the OEMs were basically not willing even to consider as part of their strategy. But we have also started to see, at least hear voices within that industry that might change. And it wouldn't surprise us that beyond what we see today, which is basically BYD and Toyota, who have a stronger involvement upstream, up to mining, the rest of the OEMs, they're really far away from that. I'm going to skip that, but this is simply a slide we use a lot to show how connected today this industry is, how many equity relationships there are, and how few independent assets are out there. So basically, most of the assets which are within this the timeline to be producing in the next 5-6 years, there is already somebody involved with them, and that of course creates also big anxiety on the side of buyers, of important lithium consumers at the end, who don't know how to secure their lithium, which is what they're fearing today. This is also translated into the value of assets. And this is a timeline in which we plot the different transactions in the M&A space of pre-capex assets. And the metric we use here, we say, okay, how much was paid for that asset and how many tons, or how much was valued that asset for, how much was that asset valued, and how much was paid per ton of planned capacity or suggested production capacity on a yearly basis. And you see this inflation, how this has been over the last 2 years. We have gone from prices around $5 per kilo of installed capacity to levels today between 40 and 50. So at times 10 in just 2 years, right? Again, there are not too many assets at an advanced development stage which are today available, and that's why that has reflected in the value which has been paid for those assets. I'm going to skip this one for sake of time, but well, maybe simply show it very simply here on the graph, on this column. We see today we can divide this lithium industry in three stages: mining, lithium chemical refining, and consumption. On the mining side, we see that Australia is the biggest one, and together with Chile today, they produce around 75% of the mined lithium in the world. On the chemical side, though, that changes because Australia essentially today is simply producing just concentrate, and most of that refining takes place in China. So now what we see is that China is the biggest refining country, and Chile followed by Chile. So and between these two countries, they produce 90% of lithium chemicals today. And finally, in terms of consumption, well, that consumption of that lithium today, I think it's also 95% of the lithium consumption today takes place basically in China, Japan, and Korea. So it's from a geographic point of view, a very unbalanced supply chain. But there are two facts. Resources are where they are. You cannot move in or invent them somewhere else, right? And this is the origin for the situation. Now, geopolitically, there's also a lot of discussion about how the West or the non-China world is so vulnerable to lithium. Well, when I look at this, I say, well, China is also quite vulnerable. I mean, they don't have really large resources of lithium. Looking further into the supply, also 5 years, the source of supply will be mostly minerals coming primarily from Australia. Brines, which come primarily from South America, will also grow, but the truth is that development time of mineral resources is much quicker than that of brines. And we will see probably 2/3 of the global lithium supply coming from mineral extraction. In terms of country, evidently Australia is going to maintain a leading role, followed by Chile. Also Argentina coming in big, and China as well, with all the developments they're doing with the lower grade lithium resources which they have in China. And finally, how does our supply demand balance look for the next 5 years? When we plot our supply and our demand, which we construct independently from bottoms up, we see that in the graphics, they are quite close together, meaning that we foresee that this tight lithium availability situation today will probably extend at least the next 3, 4, 5 years, right? Why are we think this? I mean, the numbers show this, but we also have seen in the past that demand has always been higher than what we have forecasted and supply less than what we have forecasted. So, here I think the probability that demand is higher is bigger than that the demand is lower. On the supply side, the other way around, we think that the probability of a lower supply is higher than that of a higher supply. Therefore, a very tight market for the next 4 to 5 years. I want to show you this simply as an anecdote, but it also, I mean, for those of us who have been in this industry for many years, many people ask us, why did you not foresee what is happening today? And I got back to our files of 2018 and the demand we were forecasting at that time. And you see for 2022, we're forecasting 475,000 tons of lithium carbonate equivalent demand. Well, it will end up being close to 700,000 tons. So that's a miss of 50% in just 4 years. Why didn't we see that? Well, EV sales jumped much quicker than anybody in the industry was forecasting at that time. Yeah, and I think I will leave it here and simply maybe just a last slide here on where we see prices, because that we also get a lot of questions on that. Well, we see the next 5 years like a period of lithium shortage. And for that, we think that prices will have a high probability of remaining at a very high level, abnormally high level in relation to cost of production or marginal cost of production. So we give a range here of $40 to $100, which is a quite wide range. The years after, the following 5 years, so let's say from 27 to 31 or something like that. Well, there we make this range even broader, wider, because today, if the demand continues growing as it is growing, it is hard to imagine how we're going to supply that. But on the other hand, there's a lot of money going into this industry today. And that money might yield production we're not foreseeing today. So assets which would have not even mapped that could be in production in 5, 6, 7 years from now. And for that, and that could be in a scenario, an oversupply scenario. So again, here we see prices could go back to levels of in the $20 range, right? But if that doesn't happen, well, we could also see this 80, 100 we're seeing today. And finally, when we look at 10 years from now, that's where we see recycling becoming a very important source of supply of lithium. And there, at that point in time, the need for primary lithium will decline significantly. The need of growth of supply of primary lithium. Most of the demand growth will be supplied by secondary lithium, recycled lithium. And that's why we think that's the time where we should, with a bigger level of certainty, see prices which have more a relation with incentive prices to develop assets or marginal cost of production. And I think that's it. And I hope I didn't extend myself too much, but that it gives a good overview of how we are looking at the market today. And yeah, and maybe it gives a context to start the conversation.
Yeah, absolutely. Certainly. Thank you, Daniel. Very good. I just wanted to ask a quick follow-up question about how you do your forecasts. Are you quite conservative? Obviously, there's been some history of sort of analysts, financial institutions, big banks calling the sector supply and demand balance wrong. I don't know whether that's because of some agenda, maybe misunderstanding of the sector, perhaps, and not really being able to look at some of the important factors that you've highlighted there. But I just wanted to ask around your formulation of that assessment.
Yeah, no, I would say, I mean, it's constructed on the demand side. I think there we have to rely a lot on in general consensus of what is going to happen in this industry. The truth is we have missed it always. It always has been more than this consensus. Right? I think OEMs have a big responsibility in that, in the sense that they're quite cautious at the moment in which they make the disclosure. And in my past life, when I was with SQM and I had access to sit and open heart conversations with OEMs. Well, I'm talking 4 or 5 years ago, when I looked at their forecasts, which they did not make public, they were significantly higher than what we were having, like as an industry view individually. But yeah, if we would have added all of that at that time, we would probably have been closer to what we're seeing today. And that's why, but still that view, you need to be in the talks, in discussion with each of the OEMs one by one, and they don't disclose it. So I think part of the drama we're living today has to do with that. The other side has to do with the construction of the supply. And that is something where I think in general, there is a gross underestimation of the challenges of producing lithium. Mm. And this is not a chemical plant, this is mining. And with mining you have geology, hydrogeology, hydrometallurgy. You have a lot of sciences where there's not too much know-how. If you think that in 2017, global production was 200,000 tons, and we need in 5 years from now to produce 1.6, 1.7 million tons. That's 8 times than what we produce in that. Well, the people who know how to produce lithium, they only knew how to produce 200,000 tons. And now you have to multiply them by 8. And that is the real challenge. And from the work we have done at iLi Markets in looking at assets, participating in more detailed reviews of projects, I would say in general, the findings are that the maturity level of assets is significantly lower, of the engineering, I mean, significantly lower than what you would need in order to meet the deadlines or the targets of production which are being set forth, announced.
Yeah, excellent, very good. Okay, well let's move around the panel now and get some views on this. David, could I turn to you? You know, you've been involved in many segments of the supply chain, from OEMs to investing, and you're looking at the technologies as well as the actual mining and resource supply challenge. What's your take on this gross underestimation, perhaps, of the challenges of producing lithium and getting this supply to market?
Yeah, I'd have to say, like the chronic underestimation of supply is indeed something that's persisted over time. And it really comes down to, I think, a couple of factors. One is that, in broad strokes, in the junior mining space in particular, there's always a storytelling aspect for which there is an optimistic view on the future. And what I mean by that is, projects will come and seek out investments and do roadshows and stuff like that, on the basis that they'll project a certain sort of time frame to come to production. But reality is always, takes longer than that. And the other aspect that I would say as well is like the deployment of capital required to meet, to grow the supply to meet demand, should have happened much earlier. I mean, capital's being deployed now in a significant way, in a very meaningful way. But some of these sort of outlooks could have been better planned had investment sort of been allocated, earlier. The other thing I would mention as well is that, lithium as an industry is quite embryonic. It's a small niche market, or has been. And it's now about to turn into, in terms of volume, something that just reflects more of a commodity market in the future. And that means that ways of extracting, lithium, whether it be from hard rocks or clays or brines, there are ways to improve the ways you can do extraction across all of these different types of resources that have not been invested in. But again, there's a pathway forward now where you'll be able to unlock new types of resources that, 5 years ago, folks would have just thought, no, this is not going to be a part of the commercial growth strategy of the industry, and indeed you'll start seeing that there are innovations that unlock new resources effectively. But again, it takes time, and the deployment of capital. Like the deployment of capital is a meaningful sort of bellwether as to how quickly you might be able to grow supply.
Yep. Very good points. And just picking on a couple of those, obviously the sector's been undernourished in terms of capital, as you say. Much of junior mining, for that matter, has since the sort of previous, maybe China-led 2000s commodity boom, we could say. So are you seeing new capital coming into the sector, though? Is that an area, and perhaps we can share this around the panel as well, if you think about how lithium's essential for cars and greening the world, has that narrative triggered, VC Silicon Valley capital, for instance, to move into this resource game? What's your take on that?
Yeah, I would say that VC funding has not entered the resource space, but has entered the innovation space. So
right. Ways
of extraction technology platforms, that there has been investments from the VC side there, and I still struggle to see VCs sort of going, oh, we're going to not only invest in the technology, we're also going to invest in resources. I don't see that gap being closed per se. But what I am seeing, though, is say oil and gas funds and oil and gas entities are taking a very serious look at the lithium resource space. And that spans across both resource investment as well as technology and processing capabilities as well. One example of many or a couple of examples is Koch Industries making investments. They're traditionally oil and gas. Schlumberger made an investment in EnergySource minerals as another good example, and I think you'll start seeing more of that moving forward as well.
Yep.
I would just add, just responding to your question about the VCs investing in mining. Basically, every time that anyone's trying to raise money in Silicon Valley for anything lithium related, but anything mining related, I find now too, I get a bunch of emails asking for catch-ups and stuff, and I'm just like, so sometimes like it's either like two things. It's like a fine company with like insanely silly questions from these investors, or it's like a pitch deck that looks like it was put together by like a high schooler that's like so bad that demonstrates that someone's just radically not serious. And like the VCs, like the Silicon Valley kind of ecosystem, just like does not know how to parse those things at all. They have no priors, they have no experience. Right. They don't understand the science, they don't understand the industry, they don't understand anything. So I don't know if they're going to matter to some extent. I'm sure that some interesting technology solutions will get funded out of here, but I think a lot of really silly stuff is going to get funded too, and is getting funded. I continue to be like confused about like where technology innovation can or should or will come from for battery metals or any material. Because I am sometimes just truly shocked by the type of stuff that people put money into here and other places too.
Is this part of the disconnect though, like kind of a bit what David was saying around junior miners needing to be promoters, because it's catch-22. You need the capital to go in the ground and then get the product before you can then return to investors, if you see what I mean. And there's a little bit of believing the story there before you can have the result, certainly at the exploration early stage end of it, and that sort of communication battle, or maybe the VC money doesn't see the value in that kind of investment.
I just wanted to add something here, if I could. I was just going to say that, so SQM is one of the only companies that has been able to increase capacity on schedule, in fact, ahead of schedule. And of course, we're brownfield. We've been producing in the Sierra de Atacama for many decades. But I will say that 18 months ago, when the price of lithium was $4,000, $5,000, $6,000, we continued to forge ahead with our investments. We continued to increase our capacity as originally planned. But there were a lot of people, investors asking, why are you doing this? Why are you doing this now? Does it make sense to continue investing? So I think that the market and the investment community, it sometimes has a very short memory, and it's very short-sighted too. They're not looking as much to the future as maybe they say they are, because money in the end talks. And if you're not investing in projects when the price is 6, then as David says, you are going to miss the opportunity. I think that's what we're seeing now. Many projects were delayed, were even canceled years ago or a year and a half ago when the prices were low. And these are projects that take minimal 7 to 8 years to develop. I'll just give a reference of our project in Australia, the Mount Holland project. This is a great project. It's on schedule. But by the time it's operating, it's a 7 to 8 year project with SQM, West Farmers, our partner. I mean, there's no financial issue there. There's no, there's no expertise problem. We're in this market, and it's still going to take that long to develop. So, so just some thoughts I had listening to the other panelists.
Yeah, no, definitely. That's fair. If anyone wants to sort of talk about that, the development timeframes and the short-termism of investor expectations is always a challenge for this sector, for sure. But you raised some interesting points around sort of, and it stems from some of the other points we wanted to tackle around ESG and the sort of greening the world narrative. If Kelly, maybe you could comment on whether you think new forms of capital or new funds or are looking at your business, maybe, as a producer and a sort of integrated chemicals company almost. Does the narrative now for greening the world suddenly change who you can talk to? It's not sort of pure chemicals related investors or mining related investors. We should be having a broader catchment of capital providers. Equally, I'm very aware that ESG has taken a lot of capital off the table. If we think about pension funds, private equity, for instance, and the LPs moving away from oil or moving away from companies that don't meet the Paris Climate Accords, for instance, or talk about Scope 3 emissions, for instance. But yes, just wanted to get your views on the expanding pool of capital providers.
Yeah, I think SQM's a bit unique. Of course, we're a lithium company, but we're a mining and chemical company as well. And lithium today, of course, is the most important product that we're producing in terms of contribution to gross profit. But that's today. That's the last 12 months. I mean, we're a fertilizer producer, the biggest producer of iodine, so we're a little bit different. And I think that the investment community that we talk to is probably a bit different than a junior mining company or a junior lithium company, because there's a lot more to our portfolio. And then just in terms of ESG and a focus on ESG, I do think that it is important. And I think that that's across the board. That's, and every investor sort of wants to understand ESG, whether it's because they want to check a box to say they did it, or whether it's because they're truly going to make an investment decision. I think that's probably another conversation, and probably a lengthy conversation, because I'm not sure. Again, money talks, and I'm not sure that the ESG platforms or the ESG goals of companies is necessarily driving the investment decisions as much as one would like to believe.
Yeah, very interesting. Good point. Well, it seems to be moving crosshairs with the ESG requirements from year to year, and a lot of investors that we've spoken to, certainly in mining in North America, have always said the pendulum swung a bit too far. As you say, the money talks. So it's a sort of case of relaying that to what your ESG communication is. But in terms of like sustainability within the sector, what are some of the innovations that are coming around that are impacting your work, maybe as a producer? And then perhaps we'll go around the sector as well and talk about how the industry is having to think about carbon capture, or looking at DLE as this promised technology that's going to reduce the emissions within the production process?
Do you want me to start with that?
Yeah,
or
maybe you start and then we'll work around.
Sure. Well, I think that just sort of thinking broadly, I think that any technology that's potentially available needs to be looked at. And I think it is being looked at today. And I think, SQM, I can speak for what we are doing specifically, but we a few years ago laid out our sustainable development plan, where we laid out goals to reduce carbon, water, and brine usage. But more recently, just a month ago, we laid out this roadmap, I would call it, the Solar Futuro roadmap, where we are going to ultimately include advanced evaporation technology, potentially DLE, increasing yields through new technologies. Now, exactly which technologies we're going to use, that's not defined yet. But I think we put this plan out there because, again, these are very, very long lead time items. It's technology that maybe isn't completely developed. There's engineering involved, and of course, there's environmental permits involved. So when we think about these new this innovation or new technologies, we are looking potentially 8 to 10 years to the future. But I think for us, anyways, it's very important to have this roadmap so that we are pushing ourselves to look to the future, and not just internally, but that we're telling all of our stakeholders, so that we can help be pushed to go to that next level. Because I think, similar to when prices are low, people weren't investing in lithium. This is a similar idea. We need to invest today in the future, and the future, I think, is going to be in new technology and innovation. Traditional mining in general, not just lithium. I'm not sure that that's the way of the future. Mining will always continue. There are a lot of humans on this earth that need resources, or mining resources to continue. But they are long lead items, and I think that all of the new technologies that are available need to be looked at, and many will be used in the future.
Yep, certainly. If we take a view of where I'm at over in UK and Europe at the minute, not a lot of mining on the continent, and so there's a bit of a scramble for the resources. But equally, there are some interesting plays over this way that have to be very cognizant of the European mindset for ESG and low carbon, and DLE has been championed amongst them as some of the potential solutions. But Alex, could I turn to you and get some commentary on innovation, technologies, and of course DLE expectations as well?
Yeah, I mean, I think technology development and technology improvement has tremendous roles to play to increase lithium supply in the coming decade. That involves incremental improvements to things people are already doing. For example, processing like waste streams that maybe historically couldn't have been processed and had lithium chemicals made from them. But more importantly, new technologies like DLE and other things are unlocking lithium resources that were historically not considered resources, not considered viable.
Right.
So there's probably a dozen projects across North America of folks working on making lithium chemicals from salty waters and dirt and all different types of things that historically never would have been looked at. But when the price of lithium is, if you can write $40,000 a ton into an NPV calculation, then it really changes the game in terms of what's possible.
Yeah.
So yeah.
We're at incentive pricing. Yes, certainly. David, could I turn to you for any additional commentary on sort of innovations and technologies, a little bit more depth?
Yeah. Well, and how it relates as well to ESG. I think when it comes to the way I approach projects, and when I see resources and or technologies, and do my own assessments as to whether I think the approach is a good idea. I look out for two things. One is that like fundamentally you have to try to get to lower costs of operation, lower footprint, and but really what's important is to try to innovate and design new processes for which you assume that you no longer have fossil fuels available to you, because that already and it does a couple things. One is it eliminates the cost of fossil fuel as an energy source for your process, and potentially gets you to lower costs of operation anyway. But the other aspect as well is that when you are fundamentally designing out your carbon footprint, and I see that as like just a strong pillar in terms of how innovation is going to have to move forward. The other thing I would say is that every product spec sheet that comes from a producer, you need to staple an LCA to that, so that you not only have specs of what your impurity levels are for whether you're going to meet quality spec for a cathode producer or whatnot, but are you hitting carbon emissions targets per ton of product produced? Are you reducing your water footprint, your land footprint, and so forth? And those are measurable ESG sort of like metrics that you can improve performance upon. It gets a little trickier when it comes to social and governance metrics. There are ways around to navigate through that as well, and I think that's more sort of contextual and tied to certain South America will have different social and governance kind of criteria than say a North American resource, for example, and so in that sense that you have to be a little bit more contextual, but still need to figure out ways to measure performance against on that level. And that all ties into innovation as well, like how you're going to not only innovate technologies so that you're reducing your carbon, water, land footprint, which will translate into improved social and governance performance as well, but like, is there a way that you can structure the commercial arrangements about resource ownership in such ways that again translate into like local higher, I don't know, GDP rates or whatever, something where that the locals are going to benefit in a way that is non-corrupting and improves the global environment as well as the local environment and communities.
Yep, very much so. It's that social license piece that's essential, to doing what we're doing. Right. On that note, I've had it in various other discussions around not just lithium, but natural resources. The social license piece is potentially one of the biggest challenges if we're looking at new development, greenfield stuff of this decade. I don't know if anyone's got a view there, or Kelly, if you have a view on sort of how you carry out your mandates, because you guys operate in so many different jurisdictions and environments.
Yeah, I think that one thing I wanted to mention is that in Chile, I won't speak for the rest of South America, but I do think it is a challenge that in Chile, sometimes we are just bunched into Latin America, South America bucket, and things really do operate different in each of those countries.
Totally.
And in Chile, the rule of law, environmental standards are very, very difficult. They're very specific. So again, when we're thinking about some of our plans in the future, it's not just that we're going to be able to, shove these plans down someone's throat or do them without, a very, very extensive dialogue with the community. These are all things that are very, very important for SQM. And in some cases, thinking of the future and just thinking about the Solar Futuro program, it's based on conversations with the communities and with their various stakeholders. That's what's pushing us to, in fact, invest more so that we can, ensure we're focusing, I guess, when you think of ESG, on the E and the S, because those things are paramount for our stakeholders in the north of Chile.
Yep, absolutely. Excellent. Daniel, could I turn back to you about, the promise of DLE or some of the innovations and technologies coming through? Do you have any comments on what our panels, fellow panelists have already covered so far around, the development of technology in this space and how that could be a game changer? I know in your slides at the beginning you mentioned the potential for that, and new capital could have a real positive impact on production this decade. But maybe you want to go into some of the technologies specifically.
Yeah. No, look, I think I've always been very skeptical about DLEs, and Alex and David know that. We have talked about that before. But I also have, we need to add a couple of layers now, because things have changed fundamentally in the last years.
Yeah.
First of all, the demand of lithium is so much higher than what we were foreseeing. So, and this reflects in an expectation of long-term prices, which is a lot higher than what we had in the past. This means that with these high prices, new resources, which 6 years ago we wouldn't have even looked at them, we need to find a way to unlock the lithium contained in them, and that passes, or that requires, no doubt about, technological development, including DLEs, to allow for this so to say low grade lithium resources to go to them, to reach the market. So I think that has been a fundamental change, and that is why I do think that there is space for this to develop, and we will have now a couple of years where I think technology developers will have access to resources and to prove their technologies. The truth is that going back 5-6 years ago, it was very difficult from an economic point of view to justify alternative technologies, because simply the costs were probably not competitive. And so I think this is going to naturally evolve with this need for new type of resources, and the reality of simply of a different price scale in lithium longer term.
Yep. Excellent. Does anyone care to comment on some of those points that Daniel's raised there?
Adding to the sort of context of DLE technologies and approaches, you have different approaches to DLE. You have, but when it comes to assessing a DLE technology, it's really important to consider how, a good DLE technology does two things really well. It concentrates your lithium and it rejects impurities, and comes out in a format that you could then convert to different chemicals. And there's 3 platforms out there that that are generally considered the DLE sort of capture the DLE sort of imagination. One are sorbents. That's what Livent uses, for example, in Argentina today. You have ion exchange or solvent extraction, which is very chemically intensive. So for every mole of lithium you get out of the process, you need a mole of acid and a mole of base at a minimum to extract your lithium. And you have sort of membrane technologies, which are really good at rejecting impurities, but do so at the cost of diluting your lithium. For membranes to work, you need a high amount of energy input to gain back your concentration of lithium, so to speak. And what we've seen over the last couple of years is a lot of capital being deployed in DLE platforms, VC types of funds, for example, that probably won't translate into returns. And I would say that the space has been quite frothy in that respect. There's a lot of getting ahead of your skis, so to speak.
Yeah, over subscriptions on good stories or high expectations of, promises of technology without necessarily the results yet. But it is good ultimately to have the capital and to, in a sort of progressional sense, try, fail, then succeed. I just wonder if there are any projects that strike the panel as exciting or sort of closer. Obviously, thanks, David, for the rundown of the actual technologies on DLE. That's very insightful, actually, or certainly the better ones. But are there any projects out there that are sort of the standout case where it could prove really successful? I think also the challenge on that probably is that scalability as well. Once we have the product, is the scalability going to be there at the sort of costs that are going to support it?
I mean, the project I'm affiliated with, EnergySource Minerals, I'm a huge fan of. I having had the privileged opportunity when I was at Tesla to kind of see the landscape back then of what the lithium market looks like, and navigating through where the key opportunities are, and fast forward to my engagement with EnergySource Minerals. Not only do they have a very robust and economically and operationally robust sort of DLE platform, they are actually like the only project in North America right now that's permitted for construction, and based on a brine flow that's been running for the last 10 years. And from an ESG perspective, it has amazing criteria in the sense that it really has a de minimis carbon footprint compared to almost any other type of resource you can extract lithium out of, with the again the right kind of technology that's been worked on. So that's sort of but it's a private company, so they don't necessarily capture the attention of the public markets in any way in that regard. So, but I would highlight them. I would say that there's a couple of other brine projects worldwide that have a lot of potential. But with all of these other brine resources, a couple of criteria to look for is, are they brownfield, in the sense that do they process, and are there production wells of brine for other products other than lithium today that can be leveraged, and you could piggyback lithium extraction off of that. So that's one thing to look for. The other is, if you're going to be deploying a DLE technology, you need to figure out how you're going to re-inject that brine, the lithium depleted brine, back into the resource in a way that doesn't disrupt your production wells, and enables a sustainable sort of management of the brine aquifer that you're extracting lithium from. And I think that's another sort of barrier to entry for DLE technologies on various resources, is actually you need to figure out how you're going to do the re-injection part of the the operation, and that's really critical. So I would say projects like that are so in terms of resource opportunities, like that's what I would look for, is like, are there brine resources for which there's already infrastructure for brine flow, and do they have a solution for brine re-injection? And then in the hard rock space, I mean, grade is king there, for example. Like, I am drawn towards resources for which grade is high, because that also translates into smaller mining footprint, smaller carbon footprint, et cetera.
Less intensity.
And I also, yeah, exactly. And the thing for hard rocks, I would say, is that the innovation that needs to go on there is, how are you going to mine with a diminishing carbon footprint? Because mining and refining lithium out of hard rocks comes with a large carbon footprint comparatively today, and there needs to be a way to engineer your fossil fuels out of that process effectively.
Yeah, absolutely. Excellent. Well, that's very thorough and some great points there. Look, we haven't got too long left, and I just wanted to address a couple of the questions that were posed by the panel, although audience, but I think we've sort of touched on most of them already. one of the views, one of the questions is, you know, what's the real risk of lithium substitution or reduced intensity? Sorry, is it you know, reduced intensity or use of lithium through substitution, or for the extraction industry? And we can tackle that now. You know, I would have thought it's not so substitutable, certainly in the next decade. And if you think about the battery chemistry of OEMs, it's kind of built into the plans and projections. But let me put that to the panel.
There's no escaping lithium for electric vehicles.
Yeah,
there might be substitution for lithium in stationary storage, but for mobile applications, it'll be very difficult to escape lithium, because lithium is not only the lightest metal in the periodic table, it also, when you couple it with other elements to make a battery, has the highest electrochemical potential, which means that the energy to weight ratio of lithium basically is unchallenged in terms of the elements in the periodic table. And so it'll be very difficult to escape lithium for mobile applications, so both EVs and consumer electronics. But with stationary storage, the driver there is not so much strength, energy to weight or energy to volume ratio. It's more costs, like just how much does it cost to produce, you know, per kilowatt hour capacity and cycle life. And there may be alternatives to lithium there that make a lot of sense.
Yep. Alex, you were going to jump in there.
Let me maybe compliment on that a little bit.
Yep.
I mean, the risk of substitution, I totally agree with David. In the case of EVs, probably there's nothing we would see as a substitution in the foreseeable future. Now, but there are things which could happen. I mean, these high prices will most likely lead to a effort towards reducing the size of batteries in vehicles. How do you compensate that with fast charging? And that is a little bit the discussion here. Where batteries going to go? Are they going to grow the size of a battery in an EV? Are we going to put more kilowatt hours inside the EV? Or maybe, alternatively, are we going to focus on smaller batteries but with fast charging? And that is a discussion where you have very different views on that today. But I think it has a merit to think that the average size of battery could reduce given this high battery materials price scenarios we have. The other element, which is also it's not a direct substitution, but indirectly this, is that OEMs, if they start seeing that that their profit margins for EVs are not what they would have liked to have, that they basically slow down the speed of replacement of the internal combustion engine vehicles. And there have been already some OEMs or CEOs of OEMs who have hinted to in that direction and said, why are we rushing into this if we're making good money with internal combustion? And here we're making very little, and with these high prices of raw materials, we're going to be making even less. So I think those are two elements which could affect at the end of the day the demand for lithium in EVs.
Mm-hmm. Yep. Alex, you were going to make some comments.
Yeah, I was just going to say, you know, electrochemical energy storage already has diverse chemistry, right? So all different types of batteries exist today and are used. But that, you know, I'm not saying that lithium has any really serious challenges in the next couple of years. It really doesn't. Definitely for transport, definitely for EVs. But what I will say is that all of the smartest people I know are working on things like sodium ion now. And I would have sounded ridiculous talking about sodium ion in a professional circumstance like this, like 3 years ago even. But I am not warming up to the idea of having you know, other types of battery chemistries that potentially can compete with like low energy density cathode, you know, cells like LFP, for example, whether it's for grid storage or for like, you know, low performance vehicles or something. But yeah, I will say I've been almost shocked to to realize how much focus at the frontier there actually is on sodium ion right now, as partly as a response to the supply chain constraints that we've talked about today. So
this attention surely drawn about from the resource challenge of lithium, though. You know, like everyone's scrambling for alternatives, and just to try and balance this supply demand challenge that we've got this decade, right?
Yeah.
Okay. Look, we haven't got long left. I just wanted to touch on sort of the big picture again around the Inflation Reduction Act and what the panel might think around this. You know, is it too little, too late? Is it fortuitous timing, given the way the world is now carving up its supply trade routes, or has been for quite some time, and it's now accelerated when we think about Chinese regime, Russia, etc. Is the Inflation Reduction Act going to really deliver what it promises, and will we sort of see it filtering capital further upstream around the upstream aspect of the industry? Is there a view there?
I think it's extremely helpful. It's not too little, too late. I think some of the one big takeaway I have is that it is incentivized, especially the auto manufacturers, to figure out how to optimize their supply chain in ways that are still global in context, but regional and efficient with regards to, you know, minimizing the number of steps you need to take to get from mine to gigafactory.
Yeah, excellent. It's helping to integrate. It's sort of part of this capital formation challenge problem that we've highlighted as probably one of the biggest challenges for the sector. But perhaps we could end on that. I wonder if you could each provide just what your views are in terms of the biggest challenges for the sector at the moment. Is it the speed with which we can get these new technologies deployed? Is it the permitting? Is it going to be anything in particular? Kelly, do you want to start maybe from SQM perspective? What's the big challenge for you guys to increase production?
I mean, for us to increase production, going past the plans that we've announced in Chile, I think there's going to have it's everything that you've listed. There's going to be some real challenges deciding, you know, exactly which technology would or could work best for us. Permitting is, of course, a major challenge, but I think, you know, given our environmental goals that we have outlined ourselves, I think those are equally as challenging. Reducing our water usage, reducing our brine usage 50%. Those are also very challenging, and I feel like we brought those on ourselves. But you know, I think that has to happen too. I mean, we need to be better. Everybody in the industry needs to be better when it comes to environmental footprint and social outreach.
Yep, very much so. Daniel, do you have a sort of headline view on the challenges of the sector, or is it too multifaceted to sum up?
I think definitely there are multiple challenges, but I would think that, to me, the most difficult challenge to overcome is to the lithium extraction, and because simply we are behind. The industry lost 2 years of zero investment in this industry.
Yep.
And it will be difficult to not to become the bottleneck for lithium, not to become the bottleneck in this electrified vehicle world. So I would say that is a big challenge. And going a little bit back to your the Inflation Act or Inflation Reduction Act.
Yep.
Thinking particularly of the US. I think when you look at the supply chain, clearly the US is far behind in terms of battery technology and battery production. Actually, that takes place all in Asia today. So that's definitely an area where I would focus and think that. And if that industry develops there, it brings with it all the upstream step by step. If that industry develops, you will have cathode industry developing in North America, and with that, you will start needing lithium chemicals. The truth is, today you don't need the lithium chemicals in North America because they have to go to Asia anyway, right? Because the batteries are produced there. So I would say in terms of efforts, that should be primarily be put in on the battery side. But on the other end, in the other extreme of mining, I mean, the US is ridiculous how permitting is stopping any development. And I didn't know, David, that you were the only environmentally approved project in the US. Well, congratulations for that. But it's impressive. I mean, the US wants to have everything electrified, and but there's no permitting for mining. So yes, I want the lithium, but I don't want it from here. Yeah. Now, having said that, it's also true that there's not so much lithium in North America. So yes, you have to look into Canada, you have to look into Australia, you have to look into Chile and Argentina, and that should become part of this sphere of influence of the US. And today you see how Chinese companies are basically trying to grab any asset where they can globally, because they are as vulnerable as to the US in that regard.
Yep. David, do you want to finish us up with some points on the challenges, and maybe is permitting, is that the big challenge we're facing in the sort of Western world?
Yeah, I wouldn't necessarily say it's permitting per se. I still think it's a allocation of capital. I think geopolitics is both a good thing and a bad thing, because on the one hand, it has accelerated things like the IRA. But on the other hand, geopolitics does play into slowing things down too, again, in terms of permitting and so forth. But I would say one challenge is as well as the mobilization of talent, because the lithium industry is small. It traditionally has been small. There's not a lot of technical talent in the industry. It's growing, but I think one way to solve that solution is to reallocate talent from the oil and gas industry and apply it into this space. I think there's a huge amount of we don't have to learn things from scratch per se. There's a lot of technical talent that can be reallocated from oil and gas to lithium and help to bridge the gap there.
Yeah, absolutely. So lithium is energy, reporting the energy sector into the lithium sector. That makes a lot of sense. And that's starting with the education piece, and certainly in schools.
Right.
Very good. Excellent. Well, look, that's taken us just a bit over our hour. Thank you so much, everyone, for committing your time and sharing your views. It's really good to frame the market and put it into perspective, some of the really exciting developments that we're seeing and some of the challenges that we're going to be overcoming, hopefully, in this decade. So Kelly, David, Daniel, and Alex, thanks very much for taking your time today.
Thank you.
Thank you for having us here.